Good. Good.
Desktop.
You see my?
There you go.
Great.
Awesome. All right, take it away.
Great. All right, guys. Man, fantastic stuff. Now, believe it or not, even with all this market opportunity or market volatility, there is upcoming some tremendous opportunity when things begin to quiet down, and they will start when they start quieting down. It's going to quiet down, and a lot of stocks are going to start consolidating, are going to start trending sideways, or just the statistical volatility, meaning the intraday price move, is just going to get a lot smaller, and meaning the daily moves are going to get a lot smaller, and this will happen very quickly. All right, so what we need to do is prepare ourselves with strategies that can where we can accommodate this, where we can still make money, and yet not put a lot of money out there at risk. All right, so I'm going to spend just a few minutes. I know you've been on, we don't want to go too long here, so I'm going to race through my slides. Jay is armed with the ability to reach out to me with questions, and when I do take a breath, Jay, just jump in with anything, and let's get through this. So for those of you that weren't with us yesterday, quick introduction to who I am and who is talking right now. My name is Jeffrey Beamer. I've been in the financial industry and been trading for over 30 years. I've been in this business a long time. I've been the founder, co-founder, or general partner of 3 different investment firms. I've managed 2 different hedge funds, both onshore and offshore hedge funds. I've been a mutual fund manager, and I'm heavily invested in the industry. I served as president and executive board member for the Dow Security Traders Association, and was the chairman for the Market Technicians Association, which is issues the CMT designation, which is Chartered Market Technicians designation. It's just like a CFP or CPA designation, but it's for the industry, for professional traders, and it does carry that type of weight, so the CMT designation. And I've been, not so much anymore, but have appeared in the media and the press over the years and been quoted quite a bit. I kind of got out of that side of the business because I like being kind of quieter and behind the scenes a little bit. All right, so what we're going to do today is talk about calendar spreads and why it's important to kind of learn and get a grasp on these right now. Now, some of you may know about calendar spreads and be kind of going, yeah, I know this strategy, but I guarantee that you may not know some of the nuances and some of the rules that I have in place for keeping these things very low risk, how to find these really awesome trades for very little money that have an extraordinary reward potential. And that's what I'm going to talk about a little bit today. So calendar spreads are a delta neutral strategy. So we're going to talk about delta neutral for just a minute, talk about the basics of a calendar, what to look for when looking for these things, and then an opportunity for you to become an expert in these things moving forward. So a brief overview of delta neutral trading, okay? It's unique to the securities market. So you can do it with stocks, with stocks or ETFs or even futures, but you can't do it with real estate or art or cars. You can't do it really with any other type of investment, just because you can't buy and sell something at the same time like you can in the securities market. Okay, we can buy and sell within the same security. We can buy and sell options on the same security at the same time, and that's unique to the securities market. All right, so delta neutral trading incorporates strategies used when the markets or an underlying security go in a sideways or range-bound manner, or take a sudden or violent move either up or down. Now, the latter, a sudden and violent move, there's really only 2 strategies that are delta neutral, and that's straddles and strangles, okay, that can accomplish that effect. Okay, everything else is usually dealing with a sideways or range-bound manner. Butterflies, condors, iron butterflies, and calendar spreads. And we're going to talk about calendar spreads because of all those that I just rattled off. Calendar spreads are the least complicated, the cheapest, least expensive when it comes as far as commissions go, and very flexible, adjustable, and that's what we look for. All right, so when we know about sudden and violent moves. We've been seeing that on our markets. This is an updated slide from just a little while ago, just before Tom started talking. I updated this slide. This is each one of these bars is a weekly bar. This is a 5-year chart, and just wanted to show you we are bouncing right off of this long-term moving average. And look at the magic of this particular long-term moving average. This is the 161 period moving average. And really, myself and one other technical trader named Carter Worth, who was the senior technician for Oppenheimer funds, we got into a conversation one day that we both use this this number, and it's pretty incredible. So if you want to incorporate that into your own trading, take a look and see how the markets react to it. It's pretty amazing. And what this is telling me here is that Tom talked about kind of maybe being bullish on the spider briefly. He made the comments a couple of times, not maybe long term, not. I know that was kind of a very short term outlook, right? But this is a opportunity here for a high opportunity, low risk trade here because of where we are. If we hold this level, well, then we're going to move higher, right? If we break below this current level, well, you don't want to know where we're going to go. If I measure off this pivot right here, we're looking down, about down over here at 2250. Okay, so 225 on the spider. All right, and I think that might be a little lower than what Tom was thinking. You'll notice here on my charts, I like a little bit of white space over here to the right. I don't like my stocks going all the way over to the right-hand margin because I like to visualize where price is going to go. All right, and that's part of the art behind trading. I like to visualize what my opportunity is. And so if we hold this level, we're going higher. If we break down below, and that's why this is a lowest trade if you want to be bullish, because you just put a stop down here at 273 or 269, somewhere like that, and you don't have much risk. And then if it breaks that level, then put something down here. Okay, so that's my little analysis on the market. Okay, that was for sharp and sudden moves. But what I'm going to show you is the opportunity for when this thing starts to consolidate and things get quiet, and it will be doing that here very soon. Let's take a look at how I know this, okay, is because if you look at the VIX, and this is a 5-year chart of the VIX, I wanted to show you, currently we're trading, when I snapped this shot a couple hours ago, we were trading at 52.59 on the VIX, so getting this big spike here on implied volatility, all right. However, my line in the sand is about the 20 level on the VIX. Okay, and when we drop below 20 on the VIX, and you can see here that most of the time we do spend under the $20 level. In fact, you could even argue that we spend most of the time under the $15 level. When we get back down there and we stay, that is an incredible opportunity for calendar spreads because there are going to be a lot of stocks that begin to consolidate, their implied volatility comes down, and that's where we actually need a strategy like a counter spread to be able to take advantage of those things. All right. Now, one of the things about calendars is that stocks do tend to get in a trading range and they stay there for quite a while. And here's a couple of examples. For example, Dropbox. Okay, now this was through yesterday. I know today it's a little weaker. I think it's actually pushed down below my support and resistance, or my support line that you'll see come in here in a moment. But you can see these little trading ranges that these stocks get into, and I think today it penetrated to the bottom. I didn't have time to update this slide, but you kind of get the idea. As long as it's staying in this range, we have an incredible opportunity. And then when it pierces either to the upside or to the downside, we can actually put a counter spread maybe down here at $15 on Dropbox, or maybe even $12.50, and just let the stock walk right into our profit zone. All right, and I'll show you how we construct these here in just a moment. But I just wanted to show you, here's Activision from last year in 2019, and I will be showing you slides that are current and slides from last year, because really anything over 6 to 9 months, I don't like using. I like being current and looking forward. So we won't. I could show you stuff from 18 and 17 and 2016, of consolidations and everything, but no, I mean, there was stuff, even when the market was skyrocketing last year, and going up, 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 up. Take a look at Activision here. This thing just traded sideways. Can you imagine being a shareholder in this stock and going, what the heck? Man, why? This thing's just oscillating around the 47.50 number. I mean, it's just going up and down, up and down. And I made the joke yesterday about my one of my business partners. She has 2 kids, and her 6-year-old Liam, I bring him in. I said, Liam, take a look. This stock's going up, and this stock's going down, and this stock's going back up, and this stock going down. What's it going to do next? And Liam will go, hey, it's about to go up. I'm this genius, right? Well, if a 6-year-old can do it, then you can do it too. All right, so here is ST Microelectronics. Now you might think, oh, well, this thing was just going up, 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 okay, until it stopped, right? But it was in a nice trending channel. And guess what? This is ideal for calendar spreads. And you might think, what? How can this be ideal for calendar spreads? Well, just think, if you have a nice little trend like this and it's just oscillating here, just going higher, well, all you got to do is, again, visualize where the stock is going to be in about a month and put your calendar, place your strikes where that stock will be. As long as it stays in this channel, you can forecast. For example, until the stock gap down here, if we were to take this candle right here where my laser is, which is around $32, and visualize out, I know that in about a month, this thing should have been at around $34, okay? Now, it didn't, it dropped, okay? And that's fine, because eventually all trends do come to an end and things change, all right? So take a look at JetBlue. I mean, this thing, until here it sold off. This is through yesterday. Okay, it sold off with all the other airlines, but man, for a long time, this thing just snaked around, just these little $1 moves. Okay, $1 per day, gain $1, lose $1, gain $1.50, lose $1.25. Just over and over and over again. And what kind of strategy is going to make you some money here? Well, a calendar spread will. All right, here's PBR last year. Now PBR has sold off, all right, like all the other energy guys, but man, just take a look at this. This is just channeling around this $15 level, okay? And this is this is a great opportunity for calendars. And then I updated Petrobras through yesterday, and you can see that it finally dropped down below that $15 level, and here it was gapping down. All right, so you have your support and your resistance, and it stays in that range until it doesn't. And when it doesn't, then you take your calendars off and you look for another strategy. All right, so let's quickly talk about some basics behind the calendar spreads. These things are also known as a time spread, all right? They take advantage of an underlying security which is trending sideways or in a range-bound action, either up or down, okay? So it can be trading up, it can be trading lower, but we want that predictability of where it's gonna be. And this does include stocks, ETFs, and futures. Now, the basics of a calendar spread include, this is done at a debit, okay, which creates an attractive limited risk strategy. All right, so your debits here are very limited. You're limited to the amount that you put into the trade, right? So these, let's see here, make sure my slides, there we go. They're constructed by the purchase and sale of an equal number of calls or puts, okay, that have the same underlying security, so they're on the same stock, same strike price, but different expiration dates, okay? So if a vertical spread is buy the lower, sell the higher, or buy the higher, sell the lower, okay, here we're just going sideways. We're buying a $15 call that's further out in time and selling a $15 call closer in time. And you'll see how that works here in just a moment, all right? So as I mentioned, we create a calendar spread by purchasing a longer term option and selling a near or front month option. Now that could be as short as, I could buy an option that expires 2 weeks from now and sell this week's option. Or I could buy, here we are in March, I could buy the June option and sell the April, okay? I could go even further out or spread them apart. That's the thing about counter spreads, is that they are very flexible, a very flexible strategy to work with, okay? Now, how does a strategy that involves the purchase of a longer dated option and the simultaneous sale of a near term option make money over time? Okay, well, that answer is very simple. It's time decay. All right. Now, time decay is something that happens, with options. They all have a defined date in which the option will expire. Okay, it's kind of like your insurance. Your insurance is only good till a certain date. All right, same thing here, except with options, they lose their value over time. All right, so when I buy an option, no matter how long it's dated, it will slowly, slowly, slowly lose its value until all of a sudden you get into the last 45, 30, even 15 days, and it is really selling off as far as the time value goes. Now, here's the thing. When we sell a nearer term option, it loses its value at a faster rate. And what happens here as it begins to lose its value, as you can kind of see here how it's represented, the distance between these two lines begins to widen. Okay, so the spread widens here, and this is how this trade makes money. Okay, this is how this trade makes money. So let's look, as the markets were beginning to sell off earlier this year, there were still great opportunities out there for counter spreads. All right, so this is a very recent one from last month, in fact. Okay, so this was a stock that I was looking at, Procter & Gamble. Okay, a well-known company, been around forever, and you can see that this stock just kind of plods along. I call this a Liam special because, hey, Liam, every time the stock goes down, what does it do next? He says it goes up, and every time it goes up, what does it do now? And he says it goes down, and we just go back and forth like this. Okay, now, as you can see here, it began to consolidate a little bit. It did have around the 125 level. It did dip down here, but it came right back up to this area. Now we call this acceptance, this area at 125. It just seemed like the stock was going to hang around here for a while. So here's the counter spread that was created. All right, I went out to March 20th, okay, and bought the 125 strike put. Now, I wasn't bullish or bearish. I thought the stock would go sideways, and so I could use calls or puts. And this is one thing that you need to learn about, is which one should you use? Should you use calls or should you use puts? And the answer is simple, but it does take a little explanation. Now, at the same time, I only went out to February 21st, okay, and sold the 125 puts. Now, this is on February 3rd. So this trade only had 18 days, all right? Obviously, the longer dated call had 46 days, but what the software that we use looks at, it can't look beyond this 18 days, okay? And what it was telling me is that my debit was going to be 93 cents for this position, all right? So you take 263 is my debit, and then 170 is my credit, and the difference is 93 cents. But look at this, it calculates that my maximum profit potential is $115. That's 124% potential return on risk in 18 days. All right. Now, if you look here at this delta column, you'll see that it's pretty close to delta neutral. All right. Just slightly a negative delta. All right. It had a slight negative skew here because of where the stock was trading at the time this picture was snagged. All right. But for all practical purposes, it is delta neutral. All right. And, so, okay, let's keep it right there, and we'll jump to the next slide to show you what it looks like. All right. So what it looks like is you're going to have an upper break even and a lower break even. And one thing about software is now you can visualize where this stock is going to go as it moves into the risk graph. Now, this risk graph is done in what we call modern view. Okay, it's effectively the risk graph turned over on its side, flipped around, turned over on its side, to where it makes this image to where it looks like the stock is just going to walk right into the profit zone here. All right, so as long as we stay between our break evens, then this thing would be golden. Now, here's one thing you got to get really good at when you do counter spreads. If you're not successful with counter spreads, I can almost Guarantee it's because of one thing, all right, and that's this. You don't know how to read an implied volatility chart. Okay, this thing is key to understanding. It's not hard to learn. It's not hard to learn at all. Okay, but it's key in understanding where you are in the trade and what to expect. Okay, because it can lead either to great profits or a loss in the position if you don't know what you're doing. All right, so let's move forward and talk about our exit here. All right, so we move forward to the 19th. We were 2 days before expiration, when typically I look to take these things off, okay? About the Wednesday before the Friday expiration, if that's what I'm working with. All right, my rate of return at that time was almost 50% in the trade. It was at 45%, so we had a nice little profit here. Now this is per spread, all right? So if I did 10 of these and my risk was $930, then I made $420, okay? And then you can do the math if you did 20 or 30 or whatever. All right. So, and you can see that this thing has nice open interest and nice volume on it, so it's easy to do. All right. So that's a nice little trade for just being in for 16 days. You made almost 50% on your trade. Okay. Let's take a look at the image. So part of this is knowing when to get out. Should I stay in this trade for 2 more days and try to suck this out, this time premium out? Or do I need to kind of respect what's happening with this risk graph, because it's actually telling me a message. It's giving me a message of what I should do. And that's something that I'm going to be able to show you how to do if you kind of join me beginning next week. And we'll tell you more about that in just a second. All right. So let's go to another example. This was last November. Okay. Seagate Technology, STX. I forgot to include the chart here, but you'll see it here in a moment. This stock was rallying a little bit, went out to, bought the January 17th, so that was January 17th of 2020 expiration, bought the 60 calls, sold the December 27th. And by the way, trading around the holidays, the only way to trade around the holidays is when you have theta friendly trades, meaning trades that make you money as time goes by. Okay, so you want this number right over here. See theta and see where it's positive, a positive 32? That's the type of trade that you want to be in around any holiday. Why? Because options don't stop losing their value just because it's Christmas. Okay, it value because it's Christmas. It loses value because of Easter and 4th of July and Labor Day and Memorial Day and all the other holidays that we make up, except for Ice Cream Day and Hug Day. Okay, well, even then they lose their value. Okay, so here, look at our debit here, 43 cents. You probably spent more on dinner last night than what this would cost you. The opportunity here was to make over $100. That's over almost a 200% potential reward on risk. Okay, got a little bit of time here. It's going to take about a month for this thing to work out, but here's what the trade looked like. Okay, the stock was on a bit of a rally. We went through earnings, and I like trading right after earnings sometimes because implied volatility has now dropped, which you'll see here in just a moment. And it just felt like the trend here, if I were to ask Liam, hey, Liam, what's this stock doing? He'd say, it's going up. Okay, great, Liam, thanks. And it's going to go up to where? Okay, it's going to go, well, hopefully in the next 2 weeks, it'll kind of creep up here to 60, and then we'll kind of see what happens from there. Okay, now if we look at implied volatility, you can see that it did drop after earnings, really low here on implied volatility. In fact, I can look up here at these numbers and see where it says range, RNG, that also stands for rank, and the scale is from 1 to 100, with 100 being the highest. So the highest in 1 year would be 100, okay, and the lowest in 1 year would be theoretically 0, okay, and you can see that it was really low, meaning if it rallies, that could be beneficial for our trade. And if you're not seeing that here, then you do need to join me for this class, because you will become an expert at reading this, and you will know what type of strategy you're supposed to be doing, because this is one of the most important Greeks to get a handle on, is your vega risk, okay, your volatility risk. All right, now the exit on Seagate. So we took this all 40 some odd days right down to expiration, okay, which is what we can do. It's part of the fun of them. All right, and you can see here that we made a very nice profit in the position. In fact, we made 150% in about a month and a half. All right, just killing it on this type of trade. All right. And you can see here what's happening. And to get out of these things, we bought the 60 straw call, sold the 60 call. And how to get out of this, you just buy back what you sold and sold what you bought. It's pretty easy. Okay, just reverse the trade. Here's what it looked like at 1 day before expiration. How about that? Right at 60. If you don't know what pin risk is, PIN, pin risk, you can look it up. Okay, but this thing was going to pin at 60 for expiration. All right, amazing. Okay, amazing how that works out. Okay, so STM Microelectronics, not STX, that was Seagate. So STM Microelectronics, you can kind of see, this is last year. I'm going to give you an example of last year when the market was just rallying. Okay, there were stocks that were just not, okay, and they were fun to find. Okay, so here's STM. Okay, went out, so this one was August 1st of last year, bought the 20 strike call that expires in September, sold the August 16th strike calls. Again, those were the 1750s, 17 halves. Look at my debit here, 38 cents, nice and cheap. Okay, look at my maximum reward here, $42. That's over 100% potential return in 15 days. Okay, double my money every 15 days. I'll take it. Thank you very much. Okay, but the thing is, you got to make sure that this is a high probability of happening. Okay, and that's what I'm going to show you is why do I think a chart that looks like this, where the stock is just going up and down like crazy, is going to be right here at expiration? Well, I don't know that. Okay, but what I'm going to do is set myself up for some success. All right, and part of that is knowing where implied volatility is. Okay, and you can see here implied volatility is really low. Okay, it's at 22%, actually 19% for the option that we're selling here. All right, now let me ask you a question. That past chart should remind you of what about stocks that are trending up or down? Okay, now a good example last year was Fidelity National. Look at this animal. This thing's just creeping up, just every day, up and down. And the overall trend was just, you put little trend lines on here and you can just see that this thing is just moving higher, right? Okay, so what I decided to do was go out of the money a little bit, buy the 45 strike call, sell the 45 strike call. One expired in December. That's the one I bought. The one I sold expired in September. Okay, all right. 85 cents was my debit here. Okay, I could do 10 contracts and it would be under $1,000. 800, it would be only $850. Okay, now my potential reward here, my potential was to double. Now you'll see this little odd number here. Why didn't it say I can double? It's because there's a little bit of skew going on here, which is causing this number to be not reflect my maximum risk, but my maximum risk is my debit here. All right, so as this is what I was looking at this stock to just walk right up into my profit zone and get up to that $45 level is right where I wanted it. And again, I have to check implied volatility to see where we are with that, because that's an important thing. And then when it comes time to exit it, okay, we're looking at exiting here. We're still 11 days out, but I'm looking at exiting on this, and I'll show you why here in a moment. All right, made 50% in the trade, okay, but with 11 days left, if we look at the picture, why wouldn't I stay in this for 11 more days? Okay, well, it's knowing what this black line is telling me here, right here, okay, and how much time we have left and what that black line is telling me, and that's something that we'll learn in our upcoming course. So let's talk about what's on our radar right now. You think market's falling apart, you think things are just going to heck in the handbasket? Well, guess what? There's some stocks that are not behaving like everything else, okay? There's some stocks that are quiet right now, that are consolidating, all right? So let me show you. I just grabbed a couple of things this morning before Tom and I came on, just went and looked at our software. Take a look at Walmart stores. How about Walmart after a little bit of volatility right after earnings? Look at this thing just returning back to its consolidation right around this 116 level. Okay, it's been there, it's been hanging out there. It was right around 119, 118. and then it just came down to this next level. Okay, so a trade that I found that was nice and quiet was, and again, this was today, okay, going out to May 15th, buying the 115 strike call, going to April 17th expiration and selling the 115 call for $1.10 or less. Okay, a little bit more expensive than I like, $1.10, but look at my potential profit. Okay, over 270% in about a month. All right, 200% in a month. I have the potential to. I'm all over it. Okay, now let's look at the risk graph. Oh my goodness, look at this thing. These break evens, look how nice and wide they are. Look how much room the stock has to meander around into the mouth of our trade. But is this real? Can this trade really happen? Well, remember, what's our next step? We always have to look at implied volatility. All right, so let's take a look at implied volatility on Wall. Oh my goodness, look at the implied volatility on Walmart. It is really jacked up. In fact, it's trading in the upper range, almost 100% of its 1-year average. What is that going to do to my trade when, and it will happen, it will collapse back down to its average, probably around 20, the 20 level, and it's up at, it's up at 37 and 44% right now. Okay, what will that do to my trade? And when it does crush, what happens to my trade? So this one is important to maybe watch. Don't put your money on it. And we're gonna, as we go through our class, which begins next week, we'll give you an opportunity to join that class here in a moment. When we get to that class, we're gonna go through this trade and watch it develop, and I'll show you what's gonna happen to this trade. I already know what's gonna happen to this trade, and we haven't even put it on yet, but I can tell you what's gonna happen with this trade, and I'll tell you next week in our class. All right, let me give you another example from something else today. All right, we had Barrick Gold Corporation. Okay, now you'll see Randgold Resources on the chart here. The chart just didn't update. This is Barrick Gold, GOLD is the symbol here. And you can see that, take a look at the scaling here. This stock looks like it's being pretty volatile, right? But my scale is in $1 increments. Okay, that volatility really is like a $2 range. It's not very much. All right, so for Barrick Gold, did the same thing, went out to May 15th, bought the 19 strike puts, looking at the April 17th expiration for the selling the 19 puts for 30 cents, 30 cents, okay? And look how much I can make. That's almost a 280% potential return in 30 days, okay? But let's look at the risk graph. Oh my goodness, look how wide these break evens are. Look at all the room the stock can meander around. I am making money in this trade no matter what. Or am I? What do we have to do next? We have to look at implied volatility. Oh my goodness, it's jacked up as well. That's a technical term, by the way, jacked up. All right, it's trading well in the upper end of the range here. What is this going to do to our position when it crashes? Do we need to be aware of that? Do we need to be concerned with that? Yes, but I'll tell you how to read it starting next week. All right, so how you become a calendar master is be sure to attend our upcoming masterclass, which begins next week, and Tom will tell you more about it here in just a second. By attending, you will receive the easy button, and it's my proprietary scan using a button called Calendar Trapper. And the programmers have taken my own criteria that I've used for 30 years worth of trading these things, okay, and put them into an easy button, okay, where it takes out a lot of the guesswork and a lot of the criteria that I will outline in the class, and it's already there for you. So in our upcoming class, we're going to show you how to find these consolidating stocks that increase your odds of success. Yes, even in this market. And the good news is there's going to be even more coming up soon when all this whipsaw action begins to fade away. We're going to learn how to take that list of stocks and find these high probability trades. Remember, not just sideways, but directionally too. Okay. That's the cool thing, because when implied volatility drops and stocks take off and they start running, well, guess what? We can actually put a calendar, embed a calendar up in price somewhere and just let it walk into our profit zone. We're going to learn how to filter those trades into only those with the highest probability of success, because that's what's key there. And a question that I got at an advanced seminar in Las Vegas, Nevada years ago that has stuck with me to this day: what are the nuances behind this strategy? Okay. And that question just stuck with me, because there we get into the art of trading. Okay. And there is art to it. Okay. It's all not just about algorithms and artificial intelligence. There is a bit of art to it. Okay. And lastly, we're going to talk about adjustments. Okay. We're going to talk about calendars and double counters and ratio spreads and just all sorts of stuff that involves buying and selling of different time and price with options. Okay. All that will be covered. So much will be covered in that. All right. So Jay, I kind of rapidly went through that. Any questions that popped up?
Any chance you got a moment or two to just kind of review or reiterate skew?
Sure. So let me jump back here a couple slides. Okay. So skew. This is something you're going to learn in your class, but there's a little anomaly that happens. Normally, when you go out in time, see these numbers here? Okay. A normal skew is that your further dated option, so this option, if it's 54, then my nearer term option should be probably 52 or 50. Okay, that's a normal skew, because as you go out in time, implied volatility is a little larger because there's more risk, because there's more time, if that makes sense. But every now and then there's a little anomaly that happens where this number, the front month, is actually bigger than the back month. And it's something that a professional trader, a professional floor trader, argued with me, said it can't happen. And I said, I can prove it can happen, because it does. Okay, so that's a little bit about skew, and we're going to talk about that and learn why you should be aware of it and how to find it in our upcoming class. Does that answer the question?
I believe so. Thank you. That's it.
Yes, sir.
Tom, if you want to take it back over, we're good.
Absolutely. You guys should, do you see my screen?
We just need your microphone.
Gotcha. Roger.
There you go.
And you need my screen. So we started, when I left this with Jeff, we started talking about spotting rules-based opportunities. We talked about creating a low risk, high probability trading strategy. And we also talked about planning it from start to finish. And that's something that Jeff is doing. The program that we're talking about, and we talked a little bit about this yesterday, but it is the upcoming Calendar Spread Mastery Series with Jeff Beamer. And so this is a 6-week, typically this is 5 weeks, but we're adding on a bonus 6th week to really just, because we need that time to properly go through not only the calendar spreads, but we're also talking about using calendar spreads with Darknet, which is brand new for this year. And Jeff is going to expand in on his in and out skew strategy, rolling income strategy, strategies for repairing using calendar spreads. And I did talk a bit earlier today, about repairing options, but there is a repair option for calendar spreads, and that is for options trades, not just stock. All right, so that's something that he's going to talk about in class as well. So calendar mastery includes this year 6 weeks of our 90 to 120 minute live seminar or webinars with Jeff Beamer, 12 months of recorded sessions, live case studies throughout the course. And Jeff, I'm sure you'll be following along with the case studies that you talked about here.
Yep.
Live support, access to Jeff through the members only discussion boards, and of course, much, much more. The curriculum, and this is just a part of it, all right? Calendar setup, bullish, bearish, neutral, technical setups for finding the right stocks, back-to-back calendars versus distance calendars, repair strategies for call and puts with calendar spreads, one-click scans with the calendar trapper button, and of course, live case studies every single week. That's just part of the program. Jeff also said that the calendar trapper button is included, and it is a way of finding those very best bullish, bearish, and neutral calendar spreads. It literally is 1 to 2 clicks, built-in historical backtesting. We have optimal counters using the skew. We have built-in wizards for rolling counter spreads or distance. And then he does use the in and out skew along for repair strategies. This button is included, and it's actually included for the life of the program. All right, the life of it. All you have to do is, once you're part of the program, you get this button. All you do is just maintain an active software account with us, and this button is included. And it is included. It's also found in our premium strategies, all right, our premium users box. So it's not available to everybody. It's only available to those that take this particular class, this particular series that we're doing. The triple bonus we're doing for this year. Well, first of all, we're adding in that additional bonus session. So it's a 6-week class. Typically we do these, we've done them as 5-week classes. Bonus 2 is that we're adding in calendars with darknet strategies. So that's coming on along as well. So what we're going to do is, if you need to, we're going to upgrade you to be able to use the darknet trading strategy, because you need that. All right. That also comes with our monthly or our weekly newsletter and video library, discussion boards, and live support are included. And finally, we have a money back guarantee. All right. So it's a very easy one, guys. All you do is just join us for week 1. It starts next week on March 17th. After that, take a look at it. If it's not for you, just email us back before week 2 starts, and you get a full refund. All right. With our add-on prices or add-on value, this package comes out to just over $3,000, just under $3,100. We're offering it to. We had it for the first 25 spots. We've already had spots filling up on this one. And the price is $14.95. It is the lowest price that we've ever offered. And all you have to do is go to https://TimesJet.com/20calendars, or you can just click on that. And what happens is you will then see this particular page. I'm going to put it right here in front of you. You'll see the 20 calendar piece open right here. And you can see all the information I just talked about, including what comes with it. If you want to sign up, click on the orange button, and that will take you to our terms of service. Read the terms of service, click agree. That takes you to our PayPal page. If you are a PayPal user, you just simply log in, and then you have your form of payments there through PayPal. If you're not a PayPal user, go below that, and you'll see a little gray button that says click here for debit or credit card, and you can fill the information in to pay as a guest user for PayPal. And you'll see the automatic price of $14.95 come up, which shows you that you're getting the special. Once you sign up, you will, and you've paid, you will get a confirmation and welcome letter from Jeff and I that will come immediately. And what will come with that is details on how to register for week 1. Also information on the calendar trapper button, the forums, and everything else that we're going to be offering in this particular class. All right. And I'm going to go ahead, and for those of you that are asking, there's a couple of them right now. Can I get the link here? I'm going to put it in the chat box. Here is the link to take you to exactly what we're describing and what I have on the screen right now. Let me put that. I'm actually going to put it in the Q&A box too for everybody, so you can see that. And if you click on that link, it'll take you straight to the page that you see here. All right, guys. So that is our calendar spread mastery, and this will be the only time this year that it is offered. All right. This will go away once we hit our 25 spots, or by Sunday at midnight, whichever comes first. And I am thinking that the 25 spots are going to come first, seeing as that we have several of them that have already been taken. So, Jay, are there any questions about calendar spread mastery?
Just if it includes the tools or not.
Well, if you need tools, we will include the tools for you during the calendar mastery piece. But afterwards, you'll have to pay for them. They start at $79 a month, so it's very inexpensive for everything you get with our tools.
And you'll keep the scan even if you go to the $79 a month, because you paid for the course, attended it. You will keep
you keep the scan. Yep. And so the last thing I'll mention too is that we've got several partners that are on here today. If you're a platinum partner, you're already getting this. In fact, you should have already gotten a welcome email from us. So go and check your email before you say, no, I didn't get it. You probably didn't see it. So go in there and check that out and go ahead and register for week 1. If you're a gold member or you're a silver member with us, Calendar Mastery was not included, and you can sign up here just as everyone else is signing up. So we're happy to have any partners that want to expand their partner program to include Calendar Mastery. All right. Anything else, Jay?
No, sir. That wraps it up right nicely.
Okay, awesome. Well, we've guys, I have enjoyed doing this Optionetics event. We've done 6 of these series now through March. Through the first 2 weeks of March, we've taken every Monday, Tuesday, and Wednesday, and we expanded this out. It's been a lot of fun. If I were to just kind of finish up with you, take a look at where we are. Oh, where are we? Let's see. Come on over here. All right. So let me tell you what I ended up doing here. So I looked at, I had that signal at about 25 after. That actually looking pretty good as of right now. That was the long signal. I got to tell you, based on this trend down, I didn't like that so much as I did the signal at 210 here on the bonds. And so that's actually moving, the bearish trend on the bonds is moving along really well. And so I'm looking to take that off for either a 50% profit or in the next 30 minutes at 10 after 3, whichever comes first. That's my plan. So we'll see where these end up going. Obviously, if the markets continue to rally off the low that occurred at 14.25, that's going to be good for this position right here. So either way, I'm going to end up with something. It just looked to me like the smart move was to take the trade that had come back and had its next leg down, than trying to buy something that was that had been going against me, going to catch that falling knife. I'd rather not catch the falling knife. And with the market so wild today, we're down 4.5% right now on the S&P. I like this one better. Going bearish on something that's almost at even, rather than trying to go bullish on something that's trending down and is down over 4.5% today. So, guys, I want to thank you very much for being part of our series. Those of you that are tools members, I want to mention this. All right, we are going to be doing this every week on Mondays, and so I'll have an email registration that goes out for next Monday. All right, my plan was to go to New Zealand for a couple weeks. That didn't happen, so I'm going to be right here. And so next Monday we're going to do this again. And I might do a daily series again sometime in the future. And so if I do, obviously I'll let all of you know. But this was fun. We had a good time. Hope you guys learned something over the course of, for those of you that are OptionX students, over the course of the last 2 weeks. And if you're tools users, we've been together for 6 weeks now. 6 weeks. And my biggest plan that I was doing here was, most of the case studies I showed you were profitable, and a lot of them have been to the downside lately. But I really did this just to show you and try to reiterate that rinse and repeat strategy of spot the opportunity, create the low risk trade, plan, execute, manage, rinse and repeat. Jeff here to show you another way of doing this, because some of the trades that I do involve a little more risk than normal. And what we're doing with Calendar Mastery is we're putting together trades that give you much, much less risk and have the ability to have high probability with high returns. All right.
Tom, you want to remind everybody, we're doing these on Tuesday nights starting next Tuesday.
They are Tuesday nights starting next Tuesday.
Yeah. And they're all recorded.
Anyway, guys, thank you very much for the comments. And if you really want to be kind to me, send me an email at support@tomgentile.com. Let me know what you thought about the if you're a tool member, the 6-week program that we did here, or if you're an OptionX student, what you thought about this as part of the OptionX Trading Essentials. Support@tomgentile.com. Would love to hear from you, and that'll just make me want to do this more. Thanks again, everybody. Have a great afternoon, and we'll have that recording to you as soon as possible. All right, and again, any questions also on calendar spreads, whether you are a novice or whether you are a partner and interested, again, hit us at support@tomgentile.com. We will be glad to answer them. Thanks again. Have a great afternoon. Bye now.